second conversation that we're going to have is with regards to STP. Now, investing a lump sum can be, intimidating, and especially when markets are volatile or valuations look stretched. And that's where systematic transfer plan comes into picture, offering investors a way to kind of phase their entry into markets while managing risk as well as behavior. But are STPs only useful at market peaks, or do they have a broader role in portfolio construction? To help us decode this, I'm joined by Megha Malpani, who's a CFA and partner at Zwest Financial Services. Megha, thank you so much, first of all, for taking out the time. My first question to you is that, STPs are often sold, with a quote that, it is timing the market without actually timing the market, right? So do you think that this is an accurate description, or this is just oversimplification of the concept? Help us understand what STP exactly means.
Right. Thanks, Mahima, for having me here. And I think, you rightly defined STP as, both a deployment technique and also, something which helps in structuring behavior and reducing timing risk. Having said that, it is important to understand, which deployment technique you use, because there are so many deployment techniques. You have lump sums, you have STPs, you have SIPs. Which technique has to be used on when in the market is largely contextual, and it broadly depends on three factors, which is the investor's existing exposure, what is the size of the deployable corpus, and the category of the funds being invested in. Once you evaluate all of these tools, I think it helps in creating a broader structure for the portfolio. Now let us understand how the volatility has played out over the last decade. If I have to just give you numbers, Nifty 50 has given a volatility of close to about 16%. Gold has given a volatility of close to 12.5%. Silver 24.5%. S&P 500 is about 18%. So yes, volatility exists in the market. When you see calendar year returns, it smoothens out the returns, and we do not see the various ups and downs that happen. And in that context, I think STPs are definitely a useful tool and should be used if required based on the parameters I spelled out earlier.
Okay. So then, Megha, what exactly is the purpose of STP, right? I'm just trying to understand as to what problem or risks does it solve for you? Is it the volatility risk? Is it the behavior risk? Or do you think it is the timing risk that it solves for you?
I think it's a combination of all of this. So it helps you stagger your investments based on comfort and valuations. It helps you reduce behavioral bias because, it has an element of automation, which is, the biggest problem most investors grapple with, which is they try to time the market. Third, when you do STPs, you also park the funds into liquid, low duration or arbitrage funds, which give you rates of return, which is better than the savings bank account. And fourthly, it helps you retain flexibility. I think that's a concept which, doesn't get spoken about, as it deserves attention. Within STP, you can actually accelerate your movement into equities. If the valuation becomes stretched, you can, decelerate it, you can pause it. And if market gives you an opportune window, you can actually use the entire portion lying in liquid funds to move the funds into the target equity funds over a lump sum as well. So it gives you flexibility. I think to my mind, that is the most important benefit, that STP provides. It's like a cruise control, it's not an autopilot where the investor remains in control of the funds to be invested in.
Then, Megha, how does an STP stack up against SIP in terms of where markets ups and downs are concerned?
Right. I think, Mahima, it's important to understand that both SIPs and STPs are serving two different clientele altogether.
Correct.
Now, while most investors use a combination of SIPs and STPs, it is important to understand the difference as well. SIPs are for salaried individuals, who use, the monthly income that they have to park funds into the equity markets. However, STPs are generally used for deploying lump sums. Now, when do you get lump sums? It could be either in the form of bonuses, it could be some asset sale proceeds, or it could be some inheritance money or some windfall gains, which happen time to time where the predictability and the nature of cash flows are not well defined. It is also important to understand that SIPs typically run for long periods of time. Typically, we always suggest that SIPs should continue over the earning cycle of an investor. The longer, the better, and at least a market cycle and a decade at the bare minimum for it to actually play out its course. However, STPs will run only as long as the lump sum, part remains in the liquid low duration funds. Once it is deployed, the whole funds are actually subject to market risk, so the time of investment in STP approach could be limited. Generally, what we have seen is STPs are typically done for a period of 3 months to about year and a half, depending on the valuations, the category of equity funds. Also, because equity funds are not homogeneous. If you are doing a hybrid fund, STP into an hybrid fund, you could do it for a shorter span of time. Could be about 3 months to 4 months. If you're doing large caps, also in these times, it could span for a period of 4 to 5 months. But if today you're doing mid cap, small cap, or gold, it is suggested that at least at the current valuations, it is staggered over a longer period in time. It is also important to understand that it need not be only done as far as equity mutual funds are concerned. It could be done for different categories like gold, silver, as I suggested earlier as well, and also offshore equities.
Okay, but so then, I wanted to understand as to how does one determine whether, making an STP in terms of how the duration is determined, whether it should be long term, short term, depending on your goal. Is it the same way that you generally, take into consideration for an SIP? And considering the duration, what kind of funds should one choose? I mean, I just want to understand that.
So typically, as you said, right, where the investor is ultimately investing is largely contextual. I do not think I can give you a answer for that. It depends on whether he's a first time investor, he's over allocated to a certain category, what is the amount of corpus to be invested. So which target equity fund will he finally invest in is largely a function of these factors. Now, having said that, how do you determine the duration or the frequency of STPs? As I said, it could be done on the basis of relative valuations today and how much is this existing allocation to particular category of funds. I think these two factors put together can determine the duration and the frequency of STPs.
Okay. So then, Megha, what are risk investors often ignoring in STPs? Is it the taxation? Is it the opportunity cost? What is it that they're missing? The mistakes that they generally make, and how to overcome that?
So, Mahima, it is also, important that we highlight that, STPs over shorter periods of time may not work. Like, for example, if I look at the last 1 year, somebody who started an STP into a small cap fund at the beginning of, 2025 could actually be seeing negative returns. In a mid cap fund, he might be seeing sub 5% return. Even index and factor strategies have underperformed bonds. So, in a short period, these strategies could look like they have not worked in your favor, but it is important to understand that over a longer period, which is a market cycle, these strategies have often shown to believe, have worked. In my experience, where investors go wrong is sometimes the whole purpose of STP, which is to reduce the timing risk or eliminate the timing risk, investors start trying to time the markets. I think that is when where the discipline of the portfolio, discipline of the allocation goes away. I think that is where the biggest mistake starts happening because they try to stop the STPs at the wrong time. However, it is important to understand that when the market starts falling, it is important to accelerate or maybe, kind of walk with a higher pace or drive with a higher speed on those times. But that is where we see that some investors typically tend to lose control, and that is where mistakes happen. It is also important to understand that the tax liabilities also arise when you're kind of parking the funds into liquid low duration or arbitrage funds. So that is some things, some investors, at least in my experience, they are not well aware when they have been introduced to the concept for the first time.
Megha, one last question. You mentioned that somebody who would have gone ahead and invested in small caps in the start of 2025 would be probably sitting on negative returns right now, right? So because we're seeing that sentimentally markets are not turning positive, there's still an overhang of the US-India trade deal, and that is why we can expect that 2026 could also be equally volatile, right? So somebody who's planning STP right now, what should he or she do?
I think this makes an opportune sense to use STP and not go through the lump sum route, because when you have periods of volatility, these staggered investments actually work the best during those times. I understand that we're kind of standing on a large geopolitical risk at this point in time, pertaining to the wars, pertaining to the tariffs, and they don't seem to have a closure anytime soon. And in such times, it makes a case in point to stagger the investments and use any market or correction as an opportunity to top up equity investments. Having said that, I think also investors have to be mindful of resetting return expectations as far as this year is concerned. While there are a lot of predictions that happen, but the ultimate fact is nobody knows what is going to happen in the short term. As far as your long term vision of investing is in place, I think you should be good, and 1 or 2 bad years don't make too much of a difference. These should just be used as tactical opportunities in the market.
Okay, all right. Megha, thank you so much for giving us those insights. I'm sure somebody who's watched this has understood the entire concept of STP. So thank you so much for taking out the time and speaking with us at NDTV Profit.
Thank you.
All right, viewers, we're completely out of time on this edition of Your Money Matters. I hope this episode, helps you understand SWP as well as STP. But do stay tuned. More news and updates on the other side.